Scalping is probably one of the most widely known trading strategies for day traders. This strategy is used by trading firms and hedge funds, and they literally make billions with it. It involves waiting for the market to break out and then cashing in on quick profits before it comes back down again. So why is it so popular for traders? Well, it's easy to understand, and if done properly, it can make you a few quick bucks in a single session. But how does it actually work? I'm going to share with you 3 techniques that you can use to scalp profits. I'll show you how I build these rules in Arrow Algo, and I'll show you my live trading results so you can see how successful they were. One of these strategies had a 65% win rate, and another one returned 30% in just 2 months. So stick around to find out which one. If you like this content, then remember to give me a like and a subscribe. Tell me in the comments below what you think about these strategies. Let's get into it. So what is scalping? Scalping is all about capturing small, quick profits from minor price movements. Even in a strong uptrend or downtrend, the price rarely moves in a straight line. There's always small fluctuations, and scalpers look to exploit these fluctuations by making multiple trades over a short period, taking advantage of small price changes. The core idea is to profit from these tiny waves, rather than waiting for the larger market moves as a long-term trader might. Scalping trades are usually held for just a few minutes or even seconds, with the goal of making a small percentage of profit per trade. This strategy is based on the notion that frequent small wins can compound over time to generate significant returns. Scalping relies on 3 key factors. Number 1, market liquidity. Highly liquid markets allow for fast trade execution with minimal slippage. This is critical for scalpers because they need to enter and exit the trades quickly. Number 2, volatility. While some traders avoid volatility, scalpers embrace it. A higher volatility means more price movement, providing more opportunities for scalping trades. Number 3 is precision. Scalping requires exact timing and precise execution. Traders rely on technical indicators like moving averages, RSI, Bollinger bands, and volume-based signals to make quick decisions. Scalpers typically use automated tools to ensure their trades are executed at the right moments, which is why many use algo trading platforms like Arrow Algo. Scalping is highly structured, requiring strict discipline and risk management. You're not looking for huge price swings, but small, consistent gains that accumulate over time. However, it's important to note that scalping isn't just about winning trades, it's about cutting losses quickly and managing the risk effectively. That's the theory behind scalping. Now let's dive into the strategies. Number 1, moving average. This strategy uses moving averages to identify the trend direction and some additional conditions to confirm high probability trades. The key here is to use short-term moving averages to catch quick price movements while ensuring that the larger trend is still on your side. Here you can see in my strategy that the buy signal is triggered when the short-term 9-period EMA or exponential moving average crosses above the longer-term 21-period EMA on a 5-minute chart. This tells us that the market's gaining short-term strength. But we don't stop there. We add another layer of confirmation by looking at the on-balance volume, which tracks whether the money is flowing in or out of the asset. Specifically, we want to see the 10-period OBV EMA higher than the 30-period OBV EMA, indicating that there's a strong buying pressure supporting the price movement. Finally, before pulling the trigger, we check the 1-hour super trend indicator. This is a trend following tool, and if it's signaling buy, then it confirms that the larger trend is also in our favor. Only when all 3 of these conditions are met, the short-term EMA crossover, the positive OBV, and the super trend buy signal, do we enter the trade. This multi-layered approach helps filter out false signals and keeps us trading in the direction of the trend. Now for the exit strategy, there are 3 possible ways to exit this trade, depending on the market conditions. The first condition is that the 9-period EMA is crossed back down below the 21-period EMA, meaning the short-term trend is reversed. And if we're seeing a loss of 1% or more, then it's time to exit the trade. The second sell condition is looking at the relative strength index, or RSI, on the 5-minute chart. If it climbs above 60, signaling the market is approaching overbought levels, and we're seeing a 1.5% profit already, then we'll take this profit before the market has a chance to reverse. The third sell condition is if our profit reaches 2% or more at any point, we'll lock in these gains immediately. This rule is all about taking profit before the market pulls back, ensuring that we don't get greedy and lose what we've already earned. So this strategy is designed to capture small but reliable movements, while managing the risk with tight exit conditions. It's all about jumping in when the market's in your favor, and jumping back out again before the trend reverses. Now let's take a look at the backtest results over 2 months for the Solana tethered trading pair. In 2 months, 280 trades were executed. The total return against Solana was 33.9%, and against cash it was 22.2%. The win rate was 45.71%. Now you might be thinking that that's less than 50%, but here's the key. We're managing the downside risk to limit losses with the tight exit rules. Although the win rate was less than 50%, we have rules in place to manage the risk and limit the losses, and what's important here is that our average gains are higher than our average losses. This means that even with fewer winning trades, we can still come out on top. The strategy ensures that when we do hit a winning trade, we have a higher probability of locking in a solid profit. During this 2-month window over the backtest period, Solana dropped 8.7%, and this strategy still generated a positive return, so it shows how effective risk management and profit-taking rules can lead to profitable outcomes. Number 2 is my Bollinger Band scalping strategy, which focuses on capturing price reversals through mean reversion. The theory behind this strategy is that price often reverts back to the mean after moving too far up or down in one direction. Bollinger Bands can help us to visualize this by creating an upper and lower band around the price based on the volatility. Here's how the strategy works. We first look for buying opportunities when the price hits the lower Bollinger Band, signaling that the market may be oversold and due for a bounce back. But we don't just jump in based on the Bollinger Bands alone. We need confirmation from other indicators to increase the probability of success. The first condition we check for is the 1-hour on-balance volume. We want to see that the 10-period SMA of the OBV is above the 30-period SMA, showing us that the buying pressure is building up. Then we confirm this with the 4-hour MACD, moving average convergence divergence. We look for the MACD line to cross above the signal line, indicating that the momentum has started to shift upwards. Finally, if the 5-minute price is at or below the lower Bollinger Band, and both of these conditions are met, then we'll enter the trade. Now onto the exit strategy, which is just as important for us to ensure that we take profits whenever the market moves in our favour. The first sell condition is if the price moves up and closes above the upper Bollinger Band on the 5-minute chart and we've made a gain of at least 1.5% profit, then we can exit the trade. This helps us lock in the gains when the price has moved up too far too fast, reducing the risk of a sudden reversal. The second sell condition is if the price hasn't hit the upper band but we're seeing a loss of 1% or worse, then we're going to exit to minimise the losses. This strategy is all about capturing quick price reversals and using the Bollinger Bands to identify when the market is overstretched and pairing it with momentum and volume indicators to increase the probability of a winning trade. Now let's take a look at the backtesting results. Over the same 2-month period when Solana was down 8.7%, we executed 224 trades. The win rate came in at 46%, slightly better than our moving average strategy. The total return against Solana was 42.7%, while we returned 30.2% against Tether. So although the win rate is still below 50% like the previous strategy, we're managing our risks and we're cutting losses quickly and locking in profits when the prices move in our favour. So the average gain per trade is higher than the average loss. So even though the win rate's below 50%, we're still delivering good returns. And again, the overall market's down 8% and we're still turning a profit. So combining Bollinger Bands with volume and momentum indicators works well to filter out the false signals and give you a higher probability of profitable trades. Finally, let's look at the third strategy, the RSI Scalp. This is a straightforward but powerful strategy that focuses on the market momentum using Relative Strength Index, or RSI. The RSI helps us to identify when the market's either overbought or oversold, giving us a clear signal to enter or exit the trades. The theory behind it's simple. When the RSI drops below 30, it indicates that the market's oversold, meaning that the price could be ready to bounce back up again. Conversely, when the RSI rises above 70, the market's considered overbought and a pullback's likely. So here's how the strategy works. I've got a rule here looking for the 5-minute RSI and looking for it to drop below 30. However, I don't just rely on RSI alone. I want additional confirmation that momentum is shifting upwards. So we're also going to check the 4-hour MACD to ensure that the MACD line is above the signal line, signaling that the momentum's in our favour and there's a broader uptrend in the market. Again, this is going to give us a higher probability of capturing a profitable trade. For exiting the trade, it's really simple. We're going to sell as soon as that 5-minute RSI moves above the 70 range, signaling that the market's overbought. Whether we're in profit or loss, we're going to get out of the trade at this point. So let's take a look at the backtest results. Over the same 2-month period, we executed 233 trades, and the win rate was a massive 64.86%, making it the highest of all 3 of the strategies. The total return against Solana was just under 40%, and the return against Tether was 27.7%. So despite the overall market being down 8.7%, we still locked in some pretty good gains. The key here is that the strategy doesn't aim for large moves, it simply looks to capitalize on the small reversals. allowing us to consistently come out ahead. This is a really great, simple strategy for anybody looking to get involved in scalping. Although this is only one small backtest window, if you're going to run these strategies, then remember to backtest them thoroughly over a range of different types of market conditions so that you fully understand what it is you're running. So now that we've covered the short-term results, let's take a step back. Scalping strategies are great for quick profits, but do they hold up over the course of a year, especially in bullish or bearish conditions? I ran 1 year backtest for each of these strategies, again using the same trading pair under both bullish and bearish conditions. During 2023, Solana had a huge bull run, achieving a massive 918%. So how do these scalping strategies hold up over this long-term trending period? Well, you can find out by signing up with my personal sign-up link to Arrow Algo. Arrow Algo is a free algorithmic trading software. You can use it to build, backtest and run automated trading strategies, and you don't need to know how to write code. I'll leave a link in the description below, you can go and check it out. So there you have it, 3 proven scalping strategies that can help you capture some quick profits in the market. Each one uses a different combination of technical indicators to give you a high probability trading setup. It works exceptionally well in short bursts over the right market conditions, especially for traders who prefer fast-paced trading and quick profits. You need to make sure that you've got the right risk management rules in place, just like the ones that I built today on Arrow Algo. Just remember that the key to scalping is discipline. You have to stick to the rules, manage your risk, and not get caught out or too excited by the potential of the next trade. If the conditions move against you, then you need to stop the strategy. If you found this video helpful, then don't forget to give it a like and subscribe to me for more content like this. Let me know in the comments which strategy you prefer, or if you've tried any of them out. Or if you've got your own strategies or tips, then feel free to share them as well. Thanks for watching, happy trading, see you next time.